coming to today's seminar. The purpose of this is pretty simple. It's to give you an overview of what's important in terms of the thought process involved with buying your first home. There's a lot of thinking and planning and education that goes on, and it takes time. So my belief is giving you all the information ahead of time so you can think about things, so that when you actually start the process in earnest, everything is sort of like set in place, so you're going to have a smooth transition from the search process to the actual finding the property through to closing. So I thank Randy for being here today, because one important part of the process is knowing when you can afford it. And there are some online resources to help you with that, but what is not covered is if you're looking at certain types of properties. All mortgages today have an underwriting process, which is not necessarily explained when you're getting pre-qualified. So it's looking at you as a borrower. It's also looking at the property and other things, particularly with condos and a lot of issues. I think you might be considering buying a single family, so maybe you're not going to be as affected. But people who are buying condominiums today, the lenders are looking at condo associations, so why are they qualified for the condominium association doesn't? So that's something that people need to understand. And so, Randy, I'd like you to stand here.
Please stand in that spot.
Yes, right. And explain a little bit about the mortgage process.
Okay. Hey guys. So I've got your handouts there. Go through a couple things here. I'm going to just give you a little commercial first, if that's okay. Tell you more about here too. I know we talked a little bit about it. But we actually started this company in 2000 when we got started. And since then we've grown from just this little office here, first floor, to having all this office space in the whole building, and 70 offices nationwide. We do, this year I think we're going to do about $12 billion in originations, which blows away anybody else. We're the largest independent company in the U.S. and we're actually the largest. We do more loans than anybody else in the Chicagoland area as a company. We have about 1,200 employees, 70 offices. We're licensed in 46 states, so if you know people that want to get loans in other states, I do those as well. Sometimes people get second loans in other states and such, I do that. So as you can see, our growth has been phenomenal since we got started. Our first year we did $195 million. Compared to this year, we'll probably do $12 billion in volume. As a first-time home buyer, there's a lot of different programs that are available for you. And some of you probably heard some of these terms before. FHA, VA, those are government-type loans, okay? Government-type loans are just loans that are a little bit easier to get, you know, a little lower down payment, that type of thing. And sometimes it might be right for the right person, sometimes not. And what I do is I usually will evaluate the person's situation, see if that makes sense for their scenario. So that person's generally going to have a lower credit score, less down payment, that type of thing. Conventional fixed, have you ever heard conventional? You heard that word being thrown around out? What that is, these are loans that the government basically helped form these two organizations called Fannie Mae and Freddie Mac. Okay, what they are, these are organizations that you can buy like these bonds on Wall Street, right? And by buying bonds on Wall Street, what they do is they fund these mortgages through Fannie Mae and Freddie Mac. So you think you went to Chase or somewhere, you think that they give you the money? They really don't. The money actually comes from these bonds on Wall Street. And what happens is that the rates go up and down based on how those bonds are being traded. So right now, you see, wow, these rates are ridiculous. Like for example, a 30-year fix right now, if you're putting 20% down on a single-family home, 3.375. Historically, never been here before. This is crazy rates. Great time to buy. Prices for homes are low. Interest rates are low. It's the most affordable time ever that we've ever had as far as people's available income compared to what their house payment would be. It's the best time ever to buy in the history of the United States. So you guys are lucky. I bought my house, albeit it's been many houses ago that I had before that, but 2006. The worst time to buy a house. I bought my house, my current house. this way. So you guys are very fortunate to be buying when you are buying. Then there's jumbo loan programs. So a conventional loan, Fannie Mae, Freddie Mac, in Illinois and in Chicagoland, you can get a loan up to $417,000. Okay. Above that, then you get into a jumbo loan. You see these for $1 million or $500,000, $600,000. They have different rules. Those are more portfolio loans, meaning that if you get one of those loans, the lender that you're doing the loan with is probably going to service that for you. Whereas a conventional loan, Fannie Mae, Freddie Mac, I might put you with Chase, or I might put you with Wells Fargo or Bank of America. Now that can be sold. That loan can be sold, and it does happen that way. Okay. Then there are affordable housing programs as well, which I'll kind of go through all these different programs individually as well. Then I'll get into some of the do's and the don'ts type thing, more detailed type things. So an FHA loan, look in here, you can get in with a lower down payment. 3.5% down is all you need for an FHA loan. And the great thing about that, sometimes what I'll do is I'll use it for a person that doesn't have down payment money. Okay? If you don't have down payment money, you can put 3.5% down. You can get all the money as a gift from mom and dad. So mom and dad can give you the gift. You don't have to have any of the money in of your own money, which is really nice for some people. Then they also have more flexible credit guidelines. You go down to a 640 credit score and still be approved on that. Also, they allow you a higher debt-to-income ratio, and I'll get into those terminology, but debt-to-income ratio, what that is, you'll hear that term being thrown around a bit. It's your debt payment. That includes your house payment, the taxes, homeowner association dues, student loans, car payments, all that put together. And what your payments would be, let's say that your payments are $500 per month, and your income is $1,000 per month gross. Gross meaning that is before taxes are taken out. So you make $12,000 a year, you have $1,000 a month in income. Then you have 50% debt to income ratio, because you have $500 going out, you got $1,000 coming in, not including taxes. So what happens with FHA loans, they're more aggressive that way. So people can get more house if they want to with an FHA loan, because the guidelines allow you to do that. It's really good for first-time home buyers. The other thing that I do sometimes is if a person needs a cosigner, we call them non-occupying co-borrowers. Okay, they're really good for cosigners. What we can do with the FHA loan, let's say that the client doesn't really have a job, or their parents want to help them out or whatever. I can use the parents' income, their assets, and I can put that together with the child's income and assets, or relatives' incomes and assets, and I can blend those two together internally. So I can say, okay, this guy makes $3,000 per month. This client makes, $100 a month, right? So what I do is I say their total income between the two of them is $3,100. Now their debts, this guy making $100 a month, his debts are, $100 per month. So he's at 100% on his own. Whereas this guy, his debts are, $200. So now I just take the 200 plus the 100, $300, divide that into the 3,100 between the two of them. I can use that as the debt to income ratio. Does that make sense?